Can AI read academic research and turn it into a trading bot that actually works? Not just a bot that compiles, not just a strategy with a perfect-looking backtest. I mean a real system that survives when the market changes, when volatility spikes, and when the conditions that created the edge disappear. That is the question I wanted to answer in this video. I'm going to show you every step of the process, from finding the papers to turn them into code. Here's the thing nobody says out loud. Every strategy you find on YouTube has already been arbitraged by 10,000 people who found the same video. That's why I started looking at academic research instead. Not because researchers are better traders, but because academic papers are forced to back up their claims with data. They show the sample size, they measure statistical significance, and most importantly, they reveal when an edge actually stops working. A typical YouTube strategy tells you that it works. A research paper tells you why it works, when it works, and under what market conditions it works. Those details are where the real edge comes from. Of course, there's a catch. Most academic strategies aren't directly tradable. The edge may be real, but once you factor in spreads, commissions, and slippage, the profits often disappear. That's exactly why I use Claude as a filter, to identify research that could actually survive in real markets. And in a moment, I'll show you the exact prompt I used. I reviewed hundreds of papers. Most were useless, either pure theory, impossible to trade in practice, or based on market conditions that no longer exist. Only 3 made the cut, and the reason they survived is that each one describes a completely different type of edge. That mattered more than I realized at the time. I'll come back to that when we get to the architecture. Paper 1, Schnusenberg and Medora, 2001. Do US stock market indexes over or underreact? They looked at 6 US indexes and asked a simple question. When an index has an abnormally big day, up or down, what happens next? The textbook answer is reversal. Everyone believes markets overshoot and snap back. Their finding is the opposite. One day after a big move, both winners and losers underreact. The move keeps going, and for winners, that underreaction is still measurable 60 days out. Paper 2, McGowan and Ibrahim, 2009, Day of the Week effect in the Russian stock market. They ran Garch analysis on daily returns and found returns are lowest on Wednesday and highest on Friday, and positive on literally every day except Wednesday. They call it a 3-day weekend effect, Thursday through Monday. Paper 3, Parthasarathy 2019. Predictable patterns following large price changes and volume, Indian stock market. And this one directly contradicts paper 1, or seems to. He finds that a large one-day price change, on its own, tells you basically nothing. The abnormal return afterwards wasn't significant, but add volume as a condition and the whole thing splits in 2, measured over the following 20 days. Big move on low volume leads to reversal. Big move on high volume leads to continuation. Consistently. He even spells out the trade. Buy the low volume one-day losers. Sell the one-day winners. That's not my interpretation of the paper, that's the paper's own conclusion. Read that again next to paper 1. Paper 1 says big moves continue. Paper 3 says it depends on volume. Paper 3 isn't contradicting paper 1, it's explaining it. It's the missing variable. That's the research. Now here's the part you can actually copy. 5 steps from a PDF to a compiled bot. I'll give you the exact prompts. Pause and screenshot them, they're the whole video. Step 4 is where most people quietly ruin their strategy without noticing, so stay for that one. Step 1. Find research that has a mechanic, not just a finding. OpenAlex, Google Scholar, SSRN. Search things like Day of the Week effect, price shock volume reversal, index overreaction. Add the word anomaly or predictability. That's academic for exploitable. Step 2. Do not ask for code yet, ask whether the thing is even codable. Paste the paper into Claude with this. Read this paper, tell me whether the effect can be expressed as a mechanical rule an algorithm can execute. Entry condition, exit condition, and the exact data required. If it cannot, tell me precisely what is missing. That last sentence is the whole trick. It gives the model permission to say no. Without it, you get a confident summary of a strategy that can't be coded. Step 3, and this is the step everyone skips. Turn the paper into a spec before any code exists. Convert this strategy into a written specification. List, entry condition, exit condition, position sizing, every input parameter with the value used in the paper, the data window required, and every assumption the paper makes that will not hold on my instrument. That last item is the one that saves you. The paper tested Indian equities in a 20-day window. I trade US indices mostly. Every difference is a place the edge can die. Step 5, now ask Claude to write the code. Pause the video and copy the prompt I'm showing on screen. Wait for Claude to generate the expert advisor, then paste the code into MetaEditor, compile it, and run a backtest in MetaTrader's strategy tester. Turn on visual mode so you can actually watch every trade execute on a live chart. So, can AI turn academic research into a working trading bot? Over 6 years of Nasdaq data, it executed more than 1,900 trades. It won around 40% of them. Maximum drawdown was 19%. Not bad. But here's the part most people leave out. This is only a backtest. A backtest is a hypothesis, not proof. The strategy is running live now, and I'll publish the forward results whether they look amazing or terrible. The biggest lesson wasn't about coding, it was spending time evaluating the research before writing a single line of code. If the paper doesn't contain a real edge, perfect code won't save it. In the next video, I'll test all 3 research ideas individually. If you want to test our automated trading systems yourself, you can join our free community through the link in the bio.